It's September 16th, 1992. Just imagine this. The British pound, it's absolutely plummeting, free fall.
Yeah.
And the UK government is scrambling, pulling out all the stocks, desperate.
Totally desperate. They're trying everything.
They crank interest rates way up, not just a bit, dramatically. It hits, what, 15%?
15%. Can you imagine? And they're just burning through billions in foreign currency reserves, buying pounds like crazy.
Just buying and buying, trying to prop it up. It's financial chaos, basically.
Pure pandemonium. But then there's this one figure, George Soros, who's, well, he's not fighting it. He seems almost to be directing it.
Exactly. And on that day, which everyone now calls Black Wednesday, Soros and his fund, the Quantum Fund, they reportedly walk away with $1 billion.
$1 billion, just from betting against the pound.
$1 billion profit in like a single day because he was convinced the government just couldn't win that fight.
It's one of those strays that just goes down in history, isn't it?
Absolutely. And it's way more than just a cool market anecdote. It's like the perfect high-stakes example of this really powerful, sometimes pretty complex investment strategy, global macro.
That's exactly what it showcases, the core idea. See, global macro funds, they're not just picking stocks based on, the latest earnings report.
Right, or bonds just based on credit ratings.
No. They're big decisions, they're trades. They come from analyzing and, crucially, predicting these huge political and economic shifts, like how entire countries' policies are going to clash or align, how trade is going to flow, how currencies will react when, say, something major happens geopolitically.
So they're placing bets on where the whole world stage is heading.
Precisely. They're betting on the direction of the globe, essentially.
Okay. So for this deep dive, we've really dug into the sources you send over, stuff from Investopedia, some really detailed analyses from places like Morgan Stanley, CPRAM.
Good material, yeah.
And our mission here is to get beyond the headlines, to really unpack what global macro hedge funds actually are, how they work by trading these massive world events. And we'll use Soros and obviously Black Wednesday as our main case study.
Makes sense. It's the classic example.
Yeah. So we'll look at the strategies, the huge wins, but also the big losses, the risks involved, the potential upside, all based strictly on the material we have.
It really boils down to spotting patterns, anticipating how things will play out on that global scale, and then putting capital behind those predictions, often just before these big dramatic shifts happen.
Okay, let's really dig into the strategy itself then. How do the sources actually define global macro? The core idea seems to be it's an investment technique built mostly on political and economic forecasts.
That's the heart of it, yes. The fundamental principle is that these funds build their portfolios, they decide on their trades based on projecting these large-scale events. We're talking shifts that affect whole countries or continents or sometimes the entire global economy.
So give us an example.
Okay, well, imagine a manager thinks upcoming elections in a big European country are going to lead to major fiscal policy changes. And maybe those changes are likely to weaken the euro.
Right.
So they'll structure trades to profit, specifically if the euro falls. Or, maybe they predict the U.S. Federal Reserve is going to change interest rates faster or slower than the market expects. That could lead them to take big positions in the bond market or currency markets.
Got it. And one thing the sources really stress is this incredible flexibility. They call it go anywhere, do anything.
Oh, absolutely. That's maybe one of the most critical parts. Global macro is often seen as one of the least restricted hedge fund strategies out there, meaning the managers have enormous latitude. They can take long positions betting something goes up or short positions betting it goes down. And they can do this in pretty much any liquid market anywhere in the world.
Wow. So stocks, bonds, currencies.
Yep. Equity indices, government debt, currency pairs, commodities like oil or gold. If there's an active market for it and it fits their global view, they can potentially treat it.
So with that kind of global playing field, what specific things are these managers actually analyzing? What feeds into this big picture view?
It's incredibly broad. Interest rates are obviously huge, right? They drive capital flows, currency values, bond prices.
Sure, the basics.
But it goes so much further. They dive deep into politics. They're looking at domestic policies, foreign policy, how elections might change things, shifts in leadership, new regulations.
So political risk is a big factor.
Huge. And international trade, the balance of payments between countries, that's critical too, because it directly hits currency exchange rates and economic stability. Plus, they look at other really broad systemic factors, demographics, maybe technological breakthroughs, anything that could cause these large directional waves across whole markets.
It sounds like connecting a lot of dots that might seem unrelated to most people.
That's a good way to put it, connecting seemingly disparate global events into one single coherent investment idea.
And to actually act on these big ideas, they need a pretty diverse set of tools, like you mentioned.
Oh, definitely. The sources detail the whole range. They're in the equity markets, sometimes trading individual stocks, but often using things like index futures or ETFs to get broad market exposure.
Okay.
Fixed income bonds is massive for them. Government debt, corporate bonds, even asset-backed securities. They'll often use bond futures or swaps here. Currency markets are absolutely central for many macro trades, futures, forwards, options, just buying and selling currencies directly.
Right, like the bound trade.
Exactly. Commodities too, oil, metals, agriculture. And they use complex derivatives, both to make speculative bets and sometimes to hedge their risks. This ability to use almost any instrument in any market lets them express their macro views very precisely, and importantly, often with significant leverage.
Which amplifies both the wins and the losses, I guess.
That's the double-edged sword, yes.
Now, the sources also point out that not all global macro funds are the same. There are different styles or types, right?
Yes. They break it down into a few main categories. First, there's discretionary macro. This is kind of the classic image, the grand chess master manager.
Right.
Here, the managers build their portfolios based on their own top-down analysis, their personal view of the global landscape. Their decisions come from their expert judgment, their insights, their convictions. They can go long or short, pretty much anywhere. It's seen as the most flexible type because it relies so heavily on the manager's individual calls.
So this is where that deep political and economic homework translates directly into trades based on human insight.
Exactly that. Then you have commodity trading advisor, CTA funds, or sometimes called managed futures.
Despite the name, they don't just trade commodities.
No, not at all. That's a bit of a historical name. They trade a whole range of futures contracts, including financial futures, currencies, interest rates, stock indices. The key thing here is they typically use algorithms, often based on price trends.
So it's more systematic.
Yes, very much so. Trend following is a big part of it. If the algorithm sees a price trend going up, it signals buy. If it sees going down, it signals sell. It's less about a manager's specific prediction of the future and more about identifying and riding trends that are already happening based purely on price data.
So the why behind the trend doesn't matter as much as the trend itself, for the pure CTA approach at least.
In its purest form, largely yes. The algorithm drives the action based on those price patterns. And the third main type is systematic macro.
Okay, how does that fit in?
This is more of a hybrid. These funds try to combine elements of both. They might use fundamental analysis, looking at the underlying economics and politics, to decide which macro themes or markets to focus on.
Right.
But then the actual execution, the timing of trades, how big the positions are, managing the risk that's handled systematically by computer models and algorithms.
Interesting. So it blends the human macro view with the discipline of algorithmic execution.
Precisely. A mix of human insight and computational power.
That makes sense. And, when we talk about that discretionary style, especially the kind that really captures the public imagination, makes the big headlines, well, the name George Soros always comes up. It's almost synonymous with the strategy.
Oh, absolutely. He is, without doubt, the most famous name associated with it. George Soros, Hungarian-born billionaire, hugely successful fund manager, and later a major philanthropist. The sources consistently rank him as one of the most successful investors ever. Back in 1981, he was even called the world's greatest money manager.
And the sources make a point of highlighting his particular style within macro. He wasn't a buy and hold guy.
Not at all. He's described as a short-term speculator, known for making these massive, highly leveraged bets. And crucially, his perspective was global. The entire world was his hunting ground for opportunities. No geographical limits, no sector limits, really.
Yeah, the sources draw a very clear contrast between him and someone like Warren Buffett.
Exactly. Buffett is the icon of value investing, right? Find great companies, understand their fundamental worth, buy them at a good price, and hold them for the long haul, letting that value compound.
Patient, long-term, focused on individual businesses.
Whereas Soros was making these big directional bets on huge market shifts, driven by macro events, often over much shorter periods, and amplified massively by leverage.
Betting on the whole system, not just the pieces.
You could say that. And a really central part of how he thought about this, what supposedly drove many of his biggest trades, was his investment philosophy, reflexivity.
Okay, reflexivity. This sounds important. It's a concept Soros himself developed, and the sources say it's quite different from standard economic ideas, like markets always moving towards balance or having perfect information. How did he see it?
Right. So traditional thinking often sees markets as, well, kind of passive mirrors reflecting reality. If the economy's good, stocks go up. If rates rise, bonds fall. Simple cause and effect.
Market reacts to news.
Yeah. Soros argued that's incomplete, even wrong sometimes. His theory of reflexivity says that market participants, investors, traders, lenders, borrowers, they don't just react to the fundamentals. Their actions, their beliefs, their biases, they actively influence and shape the fundamentals themselves. It's a two-way street, a feedback loop.
Okay, so it's not just the market responding to reality. The market's behavior can actually create or change that reality.
Precisely. Think about it. Market participants, driven by expectations, maybe fear, maybe greed, sometimes just irrationality, they make decisions, buying, selling, etc. These actions can push prices away from what you might call their rational value.
Okay.
But then those price movements themselves start to influence the underlying fundamentals, which then influences people's perceptions and actions again. It can create these self-reinforcing spirals, either upwards into a bubble or downwards into a crash.
The housing market example they mentioned in the source really helps picture this.
It's a perfect illustration. Imagine banks start lending really easily, maybe loosening their standards.
Okay, easy credit.
Right. People see this, they think, great time to buy a house, so more people start borrowing and buying. Demand goes up, so prices start rising.
Naturally.
But then, as prices rise, existing homeowners feel richer on paper. Banks look at the rising prices and think, hey, lending against these houses is safe. The value keeps going up, so they lend even more easily.
So the rising prices encourage more lending, which fuels more buying, which pushes prices even higher.
Exactly. It's a feedback loop. And this can keep going even if the underlying economy, like job growth or wages, isn't really supporting those crazy price increases. The market activity itself is creating this reality of ever-rising prices.
The perception is driving the fundamentals.
That's the core of reflexivity. Soros looked for situations like this where market perceptions were creating a reality that seemed unsustainable or distorted. So betting against that kind of upward spiral, maybe shorting the stocks of banks that were lending too aggressively, or home builders building too much, that would be a classic Soros reflexivity-based trade. He's anticipating the point where that feedback loop inevitably breaks and reverses, often very suddenly.
So he's trying to spot these unstable situations, these disequilibriums driven by psychology and these feedback loops, and then bet on the correction, which is often sharp.
That's exactly it. It's a view that sees financial markets not as inherently stable and rational, but as prone to these wild swings driven by human behavior and these reflexive loops, a big contrast to the efficient market hypothesis.
Okay, understanding that framework reflexivity, global macro, let's circle back to the trade that made him a legend. Black Wednesday, September 16th, 1992. We painted the dramatic picture earlier, but let's drill down into the context and how Soros played it, based on the sources.
Right. The context is absolutely key. The UK had joined something called the European Exchange Rate Mechanism, the ERM, about 2 years before, in 1990.
The ERM, that was like a precursor to the euro, wasn't it? Trying to keep currencies stable against each other?
Essentially, yes. It was designed to limit fluctuations between member currencies. They had to trade within these agreed-upon bands around a central rate, particularly against the Deutschmark, which was the anchor currency.
And the British pound was having trouble staying within its band.
Exactly. The UK economy wasn't doing great. There was pressure on the pound, and it kept drifting down towards the bottom edge of its allowed range in the ERM.
And the rules said the UK government had to defend that level.
They were obligated to. The Bank of England had two main tools: hike interest rates to make holding pounds more attractive financially, and use the country's foreign currency reserves, dollars, marks, etc., to physically buy pounds in the market, hoping to push the price back up.
So they were actively fighting the market trend.
Very actively. They'd already raised rates several times that summer. And then on Black Wednesday itself, they made those huge moves, first from 10% to 12%, then announced another jump to 15%, and they were spending billions of reserves buying pounds.
Just throwing everything at it. But Soros looked at all this and saw weakness. He applied his reflexivity idea.
That seems to be the case. He looked at the fundamentals, the weak UK economy, the inherent contradictions of the ERM peg, the political cost of defending it, the sheer size of the global currency market compared to the Bank of England's reserves.
And concluded they couldn't hold the line.
His conviction was that the government's position was fundamentally unsustainable. He believed market forces, especially once speculation kicked in, would simply overwhelm the government's ability to keep buying pounds and raising rates. It looked like a classic reflexive situation, a system under immense pressure, ready to break.
And it wasn't just that he traded quietly. The sources say he started talking publicly, saying he thought the pound couldn't maintain its ERM level.
Yes, and this is where reflexivity really comes into play potentially. Soros was already a hugely respected, influential figure. Him publicly stating his bearish view acted like a massive signal to the rest of the market.
Like shouting fire in a crowded theater.
Maybe not quite that dramatic, but it definitely got people's attention. Other speculators thought, if Soros thinks it's going down, maybe we should bet against it too. And companies or investors who held pounds started thinking, maybe we should hedge our risk, sell pounds now before they fall further.
So his prediction and his actions actually helped create the very pressure that made his prediction come true.
That's the textbook definition of reflexivity in action here. The growing belief, fueled partly by Soros, that the pound was going to break the ERM band led to more and more selling. This forced the Bank of England to intervene even more heavily, spending more reserves, hiking rates more desperately.
Which just made them look weaker and more desperate.
Completing the negative feedback loop, it reinforced the perception that the situation was hopeless.
And then came the climax on September 16th itself.
Indeed. Soros's quantum fund had already been quietly building up a massive short position against the pound, basically, a huge bet that it would fall. On that day, they started selling pounds aggressively, in enormous quantities.
And the market followed.
The scale of their selling, plus all the other speculators and hedgers piling in, it was just too much. The Bank of England couldn't absorb it all. Their reserves were vanishing fast. Even the 15% interest rate wasn't enough to stop the selling tide.
They were simply overwhelmed. The government had to give up.
They had no choice left, really. Late on Black Wednesday, the UK government announced it was suspending its membership in the ERM. The pound was floated, allowed to trade freely.
And it immediately tanked.
Plummeted, which, for Soros and his fund, who had bet billions on exactly that outcome, meant an absolutely enormous profit. The sources say $1 billion profit that day, and maybe closer to $2 billion total by the time they closed out the whole position.
Wow. That's how he got the nickname, the man who broke the Bank of England.
That's the trade that sealed it. A stunning, audacious, leveraged macro bet playing out perfectly.
An incredible story. And the sources point out, this wasn't just a one-off tactic for him. He used a similar playbook during the Asian financial crisis in 1997, right?
Yes, there were definite parallels in the underlying setup. You had several Asian economies whose currencies were pegged, either to the US dollar or a basket of currencies, much like the UK was pegged within the ERM.
And economic problems started to surface.
Exactly. As economic pressures grew in those countries, maybe their currencies looked overvalued based on their own fundamentals, they became targets for speculators.
So the same kind of dynamic played out. Speculators betting against the pegs.
Right. Just like with the pound, speculators started selling these Asian currencies heavily. This forced the central banks in Thailand, Malaysia, Indonesia, South Korea to spend their own, often limited foreign currency reserves to buy their own currency back, trying to defend the peg.
And like the Bank of England, they couldn't sustain it indefinitely.
Tragically, no. Many of them eventually ran out of reserves, or the economic pain of high interest rates needed to defend the peg just became too much politically. One by one, the pegs broke. Currencies collapsed across the region, leading to a really severe financial crisis.
That analogy in the source about speculators being like a pack of wolves descending on a herd of elk is pretty brutal.
It's striking, isn't it? It highlights how these large pools of speculative capital, often amplified by borrowing, could overwhelm the finite resources of even sovereign governments trying to defend an exchange rate target that the market viewed as unrealistic.
These are just monumental wins, trades that are literally legendary. But, as the sources rightly point out, it doesn't always go this way. Even Soros had some huge losses, especially playing this high-leverage game.
Oh, absolutely. That balance is critical to understand. When you make massive, high-conviction bets with borrowed money, the downside can be just as spectacular as the upside.
What were some of his big misses mentioned?
Well, back in 1987, before the big crash, he apparently lost around $300 million betting the market would fall. He was early on that call, though the fund itself still ended the year up, reportedly.
Still, $300 million is a serious hit.
It is. Then there was the 1998 Russian debt crisis that apparently cost Quantum Fund about $2 billion, a massive blow.
Wow.
But maybe the most painful sequence was around the dot-com bubble. The sources say he first lost something like $700 million betting against the tech bubble, shorting tech stocks. He was right eventually, of course, but way too early.
So he lost money being right too soon.
Exactly. And then, maybe stung by that, he apparently reversed course and bought heavily into tech stocks just before the bubble finally popped in 2000. That move reportedly cost him nearly $3 billion.
Ouch. That's a brutal 1-2 punch. Losing money betting against the bubble, then losing even more betting on it right at the peak.
It really drives home the point, doesn't it? Being right about the big picture, the macro call, isn't enough. Timing is everything. Leverage cuts both ways. Managing your conviction, knowing when you're wrong or just too early, is incredibly difficult.
Yeah, even with a powerful framework like reflexivity, macro trading is clearly full of pitfalls.
Extremely risky. High stakes indeed.
And speaking of risks and consequences, Black Wednesday was obviously a huge win for Soros, but it was a deeply painful and embarrassing event for the UK. Let's unpack the aftermath, the different takes on it from the sources. There was a lot of criticism, right?
Immense criticism, and you can see why. First off, the sheer waste of money. The UK government spent billions, literally billions, of taxpayer-backed foreign reserves trying to defend the pound's value in the ERM and failed. That money was just gone.
A massive loss of public funds for nothing.
Exactly. And the political damage was huge, too. It was a major humiliation for the Prime Minister at the time, John Major, and his Conservative government. They'd staked a lot of credibility on ERM membership as a cornerstone of their economic policy, a sign of commitment to Europe.
And it blew up in their faces.
Completely. Their reputation for economic competence took a massive hit. Some of the sources even draw a long historical line from that event, suggesting that the political fallout, the public feeling burned by this attempt at monetary integration, sowed some seeds of Euroscepticism that, decades later, arguably played a role in the path towards Brexit.
That's a powerful claim, that Black Wednesday had echoes leading all the way to Brexit.
It's argued, yeah, that it fundamentally altered the UK's political conversation about its relationship with Europe. Plus, you had the immediate pain for ordinary people, those sudden drastic interest rate hikes, up to 15%, hurt homeowners with mortgages, businesses trying to borrow.
While guys like Soros were making billions off the government's failure, that contrast must have fueled a lot of anger.
Absolutely. The optics were terrible. However, the sources also present the other side of the coin. There's a counter-argument that, actually, Black Wednesday had some unexpected long-term benefits for the UK.
Benefits? How so?
Well, the main argument is that being forced out of the ERM meant the UK never joined the euro. It kept the pound.
Ah, okay. And that turned out to be advantageous later.
Many economists argue yes. They believe staying out of the Eurozone saved Britain from much worse economic trouble during the European sovereign debt crisis that kicked off around 2010.
Because they still controlled their own currency and interest rates.
Precisely. The Bank of England could set interest rates based purely on UK needs, not ECB dictates. They could use quantitative easing, QE, devalue the pound if needed to boost exports. Basically, they had monetary policy independence.
And that helped the UK economy.
Some argue it paved the way for a decent economic recovery in the UK during the mid to late 90s, better growth, falling unemployment, lower inflation than might have otherwise occurred. And some sources even make the case that the cost of Black Wednesday, those billions lost defending the pound, was ultimately less than the huge sums spent bailing out struggling Eurozone countries like Greece during their crisis.
Yeah. So the perspective is really divided then.
Yeah.
Was it a national humiliation and a costly policy failure? Or was it a blessing in disguise that gave the UK crucial economic flexibility down the road?
Exactly. It's still debated today. It really shows how these major macro events have incredibly complex, long-lasting consequences, both economic and political, that people will argue about for decades.
It certainly underlines how these aren't just abstract market movements. They have huge real-world impacts, which
Yeah.
ironically creates the very volatility and opportunity that global macro traders look for.
Which brings us neatly to a really important question. If this strategy involves such huge leveraged bets on potentially chaotic global events, how on earth do these funds manage the massive risks? The Morgan Stanley source had some good points on this.
Yeah, one key thing it highlighted was that, historically speaking, global macro strategies have often done okay, relatively speaking, during big market crises.
That's one of the interesting characteristics. What's really notable is their tendency, historically, to have a low correlation with traditional stuff like stocks and bonds, especially during crises.
Low correlation meaning they don't just move down when everything else is crashing.
Exactly. The source showed data, for instance, where the correlation between global macro funds and U.S. stocks actually went down, became less correlated or even negatively correlated during big meltdowns, like the dot-com bust or the 2008 global financial crisis.
That feels counterintuitive. You kind of expect everything to correlate to one in a panic. Everything goes down together.
And for many traditional assets, that's often true. But global macro managers have tools others don't. They can short markets, they can trade currencies, commodities, interest rates. So they might be positioned to actually profit from a downturn or increased volatility, or at least lose less than someone who's just long stocks and bonds.
So that low correlation, especially in bad times, makes them potentially valuable for diversifying a portfolio.
That's the argument. Because they behave differently when other parts of your portfolio might be getting hammered, they can potentially smooth out returns or provide some protection.
The sources also mentioned some specific strategies that global macro managers might use specifically for downside protection.
Yes, two main types mentioned were long volatility strategies and tail risk strategies.
Okay, let's take long volatility first. What's the idea there?
Long volatility strategies are basically designed to make money when market volatility, things are swinging around, increases. They want positive exposure to market turbulence.
How do they do that?
Often using options. When markets get choppy or start falling fast, fear spikes, right? And the price of options, which give you the right but not the obligation to buy or sell something later, tends to go up because people want protection or want to bet on more big swings.
So being long volatility means you own things that become more valuable when the market gets jumpy.
That's the essence of it. These strategies aim to provide positive returns during those turbulent periods. And because volatility often spikes when stocks fall, they tend to be negatively correlated with equities. They can zig when stocks sag, especially downwards.
So it's kind of like buying insurance against market turbulence or a decent-sized drop.
That's a pretty good analogy. They're not literally insurance, but they can act like it in a portfolio, offering a buffer when things get rough. Buying options is a common way to implement it, since an option's value is partly driven by expected future volatility.
Okay. And then tail risk strategies. Are they just a more extreme version?
They're related, yeah. Often seen as a specific type of long volatility strategy, but they're focused laser-like on the really extreme market events. The tail events on the probability curve, huge sudden spikes in volatility, or really sharp, fast market crashes, things that are statistically rare but can be devastating.
The black swan events.
Exactly. These strategies are built to have high convexity.
Convexity. Right. Can you explain that again simply? What does high convexity mean here?
Sure. Think of a normal investment return, like a straight line. Market down 1%, you make or lose a fixed percent. High convexity means the payoff isn't a straight line. It's curved upwards sharply.
Okay.
So for a small market move, a little dip, a slight increase in volatility, a tail risk strategy might not do much, maybe even lose a little money. But for a massive extreme move, a huge volatility explosion, a market crash like 87 or 2008, you get a disproportionately large positive payoff, much bigger than the move in the underlying market itself.
Oh, so the payout accelerates dramatically in a real crisis.
Precisely. They're structured specifically to deliver potentially huge positive returns exactly when traditional portfolios are getting absolutely crushed.
So if long volatility is like insurance for a bumpy flight, tail risk is like having an ejection seat and parachute for when the plane's engines explode. It only really pays off big in the absolute worst case scenario.
That's a very graphic way to put it, but yeah, it captures the idea. Tail risk strategies are designed for those rare but catastrophic market dislocations.
Now, this sounds great in theory, having protection when things go really bad. But the sources emphasize there's a cost involved. It's not free protection.
Definitely not. It's just like buying actual insurance, you have to pay the premium. Holding these protective positions, especially long volatility strategies using options, can be expensive, particularly when markets are calm and stable.
Why is that?
Well, options have an expiry date, and their value tends to decay over time, even if the market doesn't move much. This is called theta decay or time decay.
Theta decay. So the clock is always ticking against your option position.
Pretty much. You're paying for the possibility of a big move or a volatility spike. If it doesn't happen before the option expires, the premium you paid just evaporates, or at least shrinks. It's often called a negative carry strategy. It costs money just to hold the position over time, hoping for that payoff event.
And tail risk strategies, while maybe cheaper day-to-day sometimes, they only give you that massive payout in those really extreme, rare events.
Exactly. So an investor has to weigh that ongoing cost the drag on returns during good times against the potential but uncertain benefit of having that protection kick in during a severe crisis. It's a conscious trade-off, depends on your risk tolerance and overall portfolio goals.
It's fascinating how these complex tools are used to navigate such inherently volatile strategies. Okay, let's bring this into the present. Looking beyond Soros and historical crises, what's the current macro landscape look like for these funds, according to the sources? What are the big global themes they're likely watching and trading now?
Yeah, the CPRIM source gave a really good snapshot of the key macro factors that were big in 2024 and likely to continue into 2025. And these are precisely the kinds of large-scale economic and political dynamics that global macro funds live and breathe.
Like interest rates, for example. Central banks starting to cut rates.
Yes, that's a huge one. 2024 saw the beginning of potential rate-cutting cycles in major developed economies. But, and this is key for macro, the sources expect the pace and the amount of cutting to be different in different places. They specifically mentioned potential divergence between the European Central Bank, the ECB, and the U.S. Fed.
So predicting who cuts faster or slower.
Exactly. Will the ECB move more aggressively than the Fed, or vice versa? How does that gap affect bond yields in Europe versus the U.S.? What does it mean for the euro versus the dollar? These are classic macro questions, creating trading opportunities.
Political uncertainty also seems high on the list.
Absolutely. The sources highlighted the significant uncertainty around things like the U.S. elections. Potential policy shifts, especially things like tariffs on imports from major partners, Canada, Mexico, China, were mentioned as possibilities under a different administration.
And those kinds of policy changes would have big ripple effects.
Huge impacts on trade, on currency values, on specific industries. That's prime territory for macro traders. Similarly, political developments in Europe, elections in Germany or France, shifts in EU policy direction, these all create potential risks and opportunities that macro funds analyze.
And unfortunately, geopolitical tensions are still very much a factor.
Sadly, yes. The conflicts in Ukraine and the Middle East obviously continue to create instability. The sources point out the direct impact on commodity prices, especially energy, and on global supply chains. Plus, potential shifts in foreign policy, maybe less U.S. support for Ukraine, or changes in how the U.S. engages in the Middle East. These are major events that macro funds would analyze for their downstream economic and market effects.
Government debt levels also got to mention as a macro concern.
Right. In many countries, government debt is really high. And now that interest rates are higher than they've been in years, the cost of servicing that debt is going up. The U.S. debt situation was specifically flagged as a potential issue, maybe leading to tough political fights over spending or taxes down the line. Similar concerns exist in Europe, Brazil. Macro funds watch these debt dynamics closely for potential trades in government bond markets, or maybe bets on inflation or currency weakness if a country's debt looks unsustainable.
And even the structure of the market itself, like the dominance of a few big tech stocks, is seen through a macro lens.
Yes, the sources noted how concentrated the S&P 500 had become, with the Magnificent Seven stocks making up an unprecedented chunk of the index by late 2024. Macro managers look at that and ask, is this sustainable? What could cause investors to rotate out of those names? Could easier money from central banks finally lead to a broader rally in other sectors? It's a macro-level view on market health that informs potential trades.
So it's this constant analysis of monetary policy differences, political shifts, geopolitical risks, debt sustainability, market structure. These are the big currents global macro funds are navigating today.
Exactly right. It shows that the basic idea of the strategy trading the big picture, the large-scale political and economic events, is fundamentally the same. Even as the specific events and maybe some of the tools change over time, the whole world is their playing field.
Well, this has been an incredibly detailed look into a really high-stakes corner of the investment world.
It really has. We've kind of defined global macro, seeing it's driven by these big political and economic forecasts, noted its incredible flexibility across different markets and using various tools, and touched on the different styles, from the discretionary manager to the systematic algorithms.
And George Soros, particularly his Black Wednesday trade, served as that prime example, showing how you can use this strategy, identifying that fundamental imbalance, using reflexivity, betting against even a major government, and generating spectacular results.
But, and it's crucial, but we also saw through Soros' own big losses that this is incredibly risky. Being right is hard, but timing, leverage, it means even the best face huge drawdowns. And we looked at the two sides of Black Wednesday. Was it a disaster or a necessary evil that ultimately helped the UK?
Yeah, and we got into how these funds try to manage that risk, especially in crises, using things like long volatility or tail risk strategies, how they aim for that diversification, that potential protection when things go wrong, while also acknowledging the cost of carrying that protection.
And finally, we tied it all to today. Looking at the current macro themes, the sources highlighted rate cuts, politics, geopolitics, debt, market concentration, showing how these big global forces are the constant focus for macro managers right now.
So boiling it all down, based on everything we've covered from these sources, what's the single biggest takeaway, the key lesson about this Soros-style global macro investing?
I think it really comes back to that line one source used about Soros. This kind of trading is absolutely not for the faint of heart or the light of wallet. It's just not.
Yeah.
You're taking massive leveraged bets based on your forecast of incredibly complex global events. The potential upside is huge. Yes, Black Wednesday proves that. But the potential downside is just as vast as Soros's multi-billion-dollar losses in '98 and 2000 show. It takes incredibly deep analysis, often going against the prevailing wisdom. It takes huge amounts of capital to even place the trades and ride out the volatility. And frankly, it takes serious psychological strength to handle those kinds of swings.
So it's built on seeing markets as imperfect, driven by these big forces, but actually acting on that requires, well, extraordinary resources and nerve.
You need the conviction, you need the capital, and you need the stomach to bet big on that global chessboard and watch it play out, often under intense pressure.
Which really leaves us with something interesting to think about, doesn't it? As you, listening, process all this, think about how interconnected everything is today. Global economies, politics, arguably even more tangled than in 1992. And we see how major political decisions or economic trends can just send these huge waves crashing across the entire world financially. So how does understanding this big picture thinking, this macro framework we've discussed, change the way you look at things? Not just the financial news, but maybe even the daily headlines about politics or global events.
And maybe think about what other massive shifts might be on the horizon, things driven by technology, maybe climate change, shifting demographics. What could be the next big macro theme that traders are positioning for right now? It certainly broadens your perspective beyond just thinking about individual stocks or your local economy.
A much wider lens on the world.